Good morning. My name is Karen Jones. I'm the content editor for the Society of Technical Analysts, and today we're doing a follow-up report on the S&P 500 index, which has recently rallied up and failed at its 200-day moving average. This is the daily chart. We can see the 200-day moving average here. We can also see the downtrend from the beginning of 2022, connecting the high in March, is also offering resistance in and around that 200-day moving average at 43.24. So we've failed at fairly good resistance. We've also got this Andrews pitchfork on the chart, and the median line there is also acting as resistance. We can see here that the RSI at 80 was a bit overbought as well. So no surprise really that we've seen initial failure. In order to actually have an impact on this chart and start to look a bit more negative, it will need to come down through some decent support. So where is this decent support? Your first level is going to be the June high at 41.77, but I think in order to really get this to motor on the downside, you are going to be looking at a break below the bottom of the Andrews pitchfork, which is around 41.50. Once you get below there, you should see a slide back towards at least the 55-day moving average, which is currently coming in at 3977 down here. But I think the critical factor will be on the weekly chart. Let's just flick over to that one. You can see here that in that vicinity on the resistance side, we've got the 55-week moving average, and that comes in around 43.55. And we're just fouling just shy of that. But what I want to really talk about is the DMI. This is the DMI down here. It's a directional movement index indicator. And I'm just going to show you how I use it. When the orange line here is your sell signal and the blue line is your buy signal. So when the orange line is above the blue line, it's telling you that it's negative. When the blue line is above the orange line, it's telling you that it's positive. The red line, by the way, is the ADX. Now, back here in February 2020, we saw the minus DI line, or the sell signal, break above the blue line, which gave us a strong sell signal. And the reason it was a strong sell signal is because it took out the previous peaks that we saw on the blue line. In other words, I call this a confirmed sell signal. And we can see this happened back in February, and we saw quite a considerable sell-off at that point. And then in June, we started to turn positive again, and we stayed positive for quite some time. We had a bit of whipsaw here. But in December, we started to break higher in earnest, with the orange line seeing more and more strength, the minus DI line. It took out the previous peak that we had in November 21. And then we started to see a serious sell signal on the S&P chart from about the middle of January. And if you look up to the chart pattern, you can see that it really started to sell off from that point. We really saw quite a lot of down movement. It took out the previous peak. That was a confirmed sell signal. We then continued to take out the previous orange peak. That was a second confirmed sell signal, a third confirmed sell signal, a fourth confirmed sell signal here. Negative, negative, negative. And what we have done throughout this entire correction is ease back to where we've got the plus DI line. I have to tell you that this price action here is going to be critical. Should we fail here, this will start to widen out again, and it will give me my fifth sell signal. It's definitely one that you need to watch. Thanks very much.